Diversification and risk reduction. Another possible financial economy of scope for a diversified firm has already been briefly mentioned. The riskiness of the cash flows of diversified firms is lower than the riskiness of the cash flows of undiversified firms. Let's say you have a portfolio that only has airline stocks. Share prices will drop following any bad news, such as an indefinite pilot strike that will ultimately cancel flights. This means your portfolio will experience a noticeable drop in value. You can counterbalance these stocks with a few railway stocks, so only part of your portfolio will be affected. In fact, there is a very good chance that these stock prices will rise as passengers look for alternative modes of transportation. You could diversify even further because of the risk associated with these companies. Statisticians may say that rail and air stocks have a strong correlation. This means you should diversify across the board different industries as well as different types of companies. The more uncorrelated your stocks are, the better. Firms that diversify to reduce risk will have relatively stable returns over time, especially as they diversify into many different businesses with cash flows that are not highly correlated over time. Tax advantages of diversification. Many overlook the powerful strategy of tax diversification, or the process of minimizing taxes annually and into the future by investing a variety of tax advantage accounts. These possible tax advantages reflect one or a combination of two effects. First, a diversified firm can use losses in some of its businesses to offset profits in others, thereby reducing its overall tax liability. By ensuring that an individual's retirement portfolio includes tax-free assets, the strategy of tax diversification can be used to build wealth now and in the future. Plans are guaranteed against market losses while still providing gains, if accessed properly. Second, because diversification can reduce the riskiness of a firm's cash flows, it can also reduce the probability that a firm will declare bankruptcy. By considering tax diversification as you invest, you can potentially fuel savings over time and help your asset last longer. Gain flexibility in how you access retirement income in the future and take more control of your financial picture now and in retirement. The first strategy attempts to exploit operating synergies, and second, the firm attempts to gain financial benefits from its ability to increase leverage due to a greater stability of cash flows. The results indicate that pure financial diversification is associated with more stable cash flows, lower operating risk, increased level of leverage, and lower profitability. Multi-point competition. With multi-point competition, a firm faces the same rival in more than one market. Multi-point or multi-market competition describes a situation where firms compete simultaneously across multiple products or markets, and competitive actions taken in one market trigger reactions in other markets. For example, Apple and Samsung compete in several electronic product markets in the same way that Coca-Cola and Pepsi face each other in a number of regional markets. Over the years, strategy scholars have shown that multi-market contact between the same rivals lead to different strategic responses. Multi-point competition can serve to facilitate a particular type of tacit collusion called mutual forbearance. When two firms simultaneously operate in two or more markets, the mutual recognition of their interdependencies might affect the intensity of competition, leading to a cooperation or simply to mutual forbearance. Firms engage in tacit collusion when they cooperate to reduce rivalry below the level expected under perfect competition. Mutual forbearance is tacit collusion as a consequence of firms competing in many markets and the resulting increase in their interdependence. Tacit collusion, as opposed to direct collusion, which is illegal, is a situation in which two firms understand each other's motives and strategies and implicitly coordinate to avoid competing intensely. Extant theories suggest that two different processes may be responsible for mutual forbearance as a result of higher degrees of multi-market contact. First is familiarity, and second is deterrence. Familiarity is the extent to which tacit coordination is enhanced by a firm's awareness of the capabilities and actions of a rival. while deterrence is the extent to which a firm is able to prevent its rivals from initiating aggressive actions that may be harmful to its interest in the market. It is a consequence of the ability of the firm to cause its rivals serious financial loss by retaliating aggressively to their actions. However, sometimes multi-point competition does not lead to mutual forbearance. Consider, for example, a conflict between the Walt Disney Company and Time Warner. As mentioned earlier, Disney operates in the theme park, movie and television production, and the television broadcasting industries. Time Warner operates in the theme park and movie and television production industries, also operate a very large magazine business. This suggests that firms pursuing mutual forbearance strategies based on multi-point competition are usually pursuing a form of related diversification.